Good morning, everyone around the world. It's your Uncle Bruce here from Stock Markets with Bruce, Creston, British Columbia in Canada. It is Friday, June the 11th, 2021. Welcome to the end of the week. What a week. Hope you're doing all right. We're going to talk about the stock markets in plain English. That's what we try to do all the time. Talk about the stock markets in plain English to figure out what the heck is going on out there. I welcome all of you to the program, and thank you to those of you who are giving me a thumbs ups already. You guys are great. A whole bunch of you remind everybody, hey, give him thumbs ups. He needs to get to 1,000 thumbs up, because if he doesn't get to 1,000 thumbs ups by the opening of the market, he might start playing that Yoko Ono record he's got just right over here. This is right there. We don't want that. Thank you, all of you, for popping by. I have positions in FAII and SoFi. No position in GORS. If I want to eventually write covered calls, should I increase one of my owned positions so I can write more contracts on one stock? Well, obviously, the day will come on some of these SPACs sooner or later. Eventually they'll all hopefully be in a position where you can start considering writing call contracts against these stocks and bring in income. Which one is the first one is always the question, the second and the third. If you have enough money and you can acquire, 5,000 shares of each one of these companies and just sit on them, and then when one of them reaches the, coveted price point that you want to now start writing calls against, great. But if you don't have enough money to do that, you're sitting here going, which one do I buy? You're trying to pick off the one you want. Well, you can't invest like that necessarily. You have to really be more realistic and go, well, there's certain stocks I like. There's reasons why I like them. Fundamentally, corporately, I'm going to have my position in these. If you have some call contracts, you've made your position there, and hopefully between the shares and the call contracts with the leverage, that you'll make a nice score on a move where you can perhaps roll your call contract cash into stock of that same stock, even though it's gone up on you, because your objective now is that, I made such a nice score on these call contracts, they are allowing me to buy this stock now that I'm going to immediately start writing call contracts on, because I've made my money going up. Now that it's here, I want to, get enough stock that I have on top of what I've got to start writing calls to bring in cash to solidify my hold here. That may be one way to go. The other way to go, of course, is you diversify your holdings as best you can. You've got some stock here, you got some stock here, you got some stock here. They are hopefully moving for you. And down the road, you may decide, okay, well, I got 3 different SPACs. One went up to here, one went up to here, one went over to here. I'm going to sell the 2 at the lower end and buy the top one, or I'm going to sell the top performer and the bottom performer and buy more of the middle performer, and I'm going to write calls on the middle performer because I can go from maybe 100 shares to 500 shares by making this move, or from 1,000 shares to 5,000 shares, and I want to write 50 calls or 5 calls at a time. And I believe I can bring in, say I can bring in $3 a month in premium per month per share. And with 500 shares, I'm bringing in $1,500 a month in income, where via 1,500 shares, I'm bringing in 4,500, and on it goes. You'll make your decisions at that point. But Alan, that is a quandary. How do you feel about writing cash secured puts on tickers you are bullish on for the premium? I don't have a problem with it. In other words, if you believe in, let's say you like VGAC, 23andMe, and you write put contracts against the stock. So let's say you write, I don't know, you're going to write an out of the money put, or a $10 put on the stock, where you're saying to the world, I'm going to sell this put to the market, and if I get exercised, I will buy this stock at $10. If the shares go down in price, I, as the put writer, I have to buy the shares at $10. and the contract is good for 2 weeks or 3 weeks or a month, whatever the time is. But you get paid, let's say you get paid right now $1 for a 3-week contract or a 2-week contract. I'm making all this up. None of this is official. Don't look at the charts and say he's way off. I'm just making this up. So you write a contract, get $100 to commit yourself to buy 100 shares of VGAC for $10 a share. But the shares go to $11 and $12 in the next couple of weeks, and they stay there. Again, all theoretical. That put is worthless, because no one's going to make you buy the stock from them at 10 when they can sell it on the open market for 12. So that put becomes a zero value, but you keep the buck. So you put up the money up front, $1,000 for that call contract or that put contract. You told the broker, here's $1,000. I want to sell this put for 2 weeks or whatever it is, 3 weeks. I'm prepared to buy these shares for $10 each if somebody wants to hit me with it. Here's the money. And you now have $1,100 in your account, the $1,000 of yours and $100 from the sale of the put. If the shares don't go down in that time frame and they don't stay there and they go to $11 or $12 a share or beyond 10, that contract will shrink into zero value as it expires. It'll expire worthless, and you now have $1,100 in your account, and you're under no obligation to do anything. Now you can turn around and go, oh, okay, the stock's at 12. I'm going to write an $11 put for a couple of weeks, because sooner or later, within the next few months and weeks, these contracts I'm talking about with all these SPACs will be available on the dollar. So you'll be able to buy and sell 10s, 11s, 12s, 13s, 14s, 15s, calls and puts all the way up. Anyway, you might write put contracts as an ongoing strategy just below the price of the stock or 20% below, or wherever you're comfortable with. Something like Gamestop, you tell me, yesterday morning when we were at $2.90 a share, would you have written a put for $2.50? Because it went down to $211 and it was in the money, $39. You may have been called yesterday during the day already on your put. You don't know. But at the moment, at $230 a share on GameStop, if we were open now, which we're not, you could write right now a $200 put contract on GameStop, good for today or next Friday or the Friday after. Jeremy, thank you, buddy. Thanks, Jeremy, for the PayPal donation. I just saw. You could write a $200 put. Maybe you can bring in $15 a share for, say, a 2-week time frame. Again, you have to cough up right now, up front, the money that you need to buy that stock. If you're prepared to pay $200 for it, you better put up 20 grand for 100 shares. So you've put up the 20 G's and you got 1,500 credit coming into your account because you sold that put. You wrote it. Now you're on the hook to either buy that put back if you want to end the deal, or you have to buy the stock at $200 a share, which is the 20 grand you put up. Now, if you're right and the shares stay over 200 by the time the contract expires, you keep the $1,500. Yay! Well, you made $1,500 on 20 grand. Is it a 3-week deal? Great. 2-week deal? Great. That's really good annual money. On the other hand, though, if you are forced to buy the stock because the stock goes to 180, you now have to, your 20 grand turns into a 100 shares of GameStop. Now you're sitting there going, yeah, well, I got 1,500 up front actually. So I'm really only paying 185 for this stuff because, I'm on the hook at 200. I got 1,500 up front. So I'm on the hook at, it really costing me, 185. But hey, it's down to 180. I'm down $5 on the deal. But at that point, you could go, well, I'm a shareholder of GameStop. Gosh darn it, it was at 230 when I wrote this darn put. Now it's 180 and I own this stuff. Geez. Well, you could turn around and write a call contract against it or another put contract. So you could write maybe a 150 put against your 100 shares, or you could write a one call contract at 210 or 220, good for a week or two, against your stock and bring premium in either side and play the game. Hence the classes. Hence the classes. All righty. Thank you, everybody. Do you think the volatility of these meme stocks hurts them by not having regular investors consider them as an investment? I think we're missing out on more people jumping in, or is this a new way? You know what, Vic? There are more people in your stock now because they're meme stocks than if they weren't. If these weren't meme stocks, they wouldn't be doing anything. They would be in oblivion. They would be like in the back room and no one would care. No one would be covering them. No one would be talking about them. and the management would just be trying to struggle to get any kind of exposure. There are thousands of shares out there, thousands of publicly traded company stocks out there that don't trade and are completely anonymous, and you don't want to be one of them. You just don't. You're better off being in a meme stock like GameStop and these others because of the amount of press they get and the millions of shareholders that are being attracted. Vic, you're a winner being in these meme stocks, not a loser, because you're surrounded by an army of believers. Whereas if these became non-meme stocks, they would be just dropped off and for all but forgotten. So hang in there and let's enjoy the ride. Let's see what we can do. Does it matter what day of the week to buy call options since they expire on Fridays? You got to pick the day it looks good for you. You got to pick your day and make your moves. Some of you like to play the options games on Fridays. Others of you loved Wednesdays. Some of you like Tuesdays. Sometimes it's just the stock will tell you when to make the move. Right now, looking at GameStop at 235, 236, you might want to write 280s right now. Maybe right now you want to write 290s. On the other hand, some of you are going to go, oh, this GameStop could go up another 10, 15 bucks to 250. Then I'll write 300s. How about I'll do that? You gotta feel it. You gotta feel the vibe. You gotta what's your excitement level. I mean, we have someone who just wrote a 252 contract for today, expires today. The stock's now 238, only $14 out of the money, but it's still out of the money, and there's a 350 premium. If he gets taken out, 257 or 56. It's 239 now. You got to decide for yourself how you feel this. What do you like on it? 240 on GameStop, going for 241 right now on 4 million shares of GameStop. 240 on the stock, 240.95 on GameStop. This is how this stock moves. Welcome to normal. Welcome to meme normal. Uncle Bruce, would you mind showing that list of your stock and ETF picks? Would you mind showing that list of your stock and ETF picks? Let's see if I can find that. Here's these are the SPACs right here that are still SPACs. So we got FAII, FWAA, GORS, NASH, SVAC, VACQ. And now VGAC, the one on the end, is about to become 23andMe officially on the market starting next week. So watch for that. And then here are the stock picks, which now include on the far right there, the second from the right, SoFi, which was a SPAC, the IPOE, but is now SoFi. And so they're all graduating up to here. Eventually, the SPACs will all be on this list. And there they are. Those are my faves. Those are the ones I talk about the most. And, you just have to keep an eye on them and see what you can do. E3 is this weekend, could be related. Would it be something if they were to announce a dividend of a unique item other than cash? They were to announce the release of a dividend. Oh gosh, the release of a dividend of a coin that they would be minting, that only they mint. The problem, of course, the reality would be that if GameStop said, we're going to create a coin, and the coin has a monetary value on our website, and all shareholders of record on whatever date that they hold GameStop shares will be entitled to say, for every share you have, we're going to give you $10 in coins that we are printing. In Canada, we call that Canadian Tire money. It's like a store creating money that they hand you as a rebate. But the thing is, it's a $10 gift from the company to their shareholders, but only the shareholders of the company will get the coin from the company. All those who are short the stock, they have to get their coins from the person that is short the stock. But if they can't make the coins, how do they deliver the dividend? And the only way to get out from under it is you buy up the stock on the open market to get out from underneath the obligation of having to create a dividend that you can't create because you can't buy the coins anywhere. They don't trade anywhere. They're only created by the company when the company creates them. I mean, this is brilliant. This could be brilliant. So you get a run on the paper to get the stock back to get out from under the thing. But so what if it runs the stock to 350, 400 a share? And it gets to 400 a share, 450 a share, something like that. And the company announces a 10-for-1 stock split. Now the stock's going to trade at the $40 level, 10-to-1 split. And these shorters are short gazillions of shares now, 10 times as many more. And they're on the hook for these coins because if everybody gets $10 in coins now, with a 10-for-1 split, you get $1 coin dividend. Instead of 10 for 1, you get 1 for 10. And so the shorters will be short. The stock will double from 40 to 80. And now you got an $800 stock problem on GameStop, theoretically. So in one swift move, or a couple of little swift moves like this, GameStop could get its stock into the $800, $1,000 range by offering a dividend on an item that no one can get except for the company. And the only way out from giving the dividend is to buy back your stock on the open market to take your short position off. Oh, would that run this market? That would be a lot of fun. I'd be quite happy to see that. Thank you, everybody, for that. If you'd like to talk to me about a 1-hour session, you want to get together with me, send me an email through my email address, which is right here. It's the old school hotmail.com email address. Send me an email. Say, Bruce, I'd like to talk to you on a one-on-one session. When can you book me in? I'd like to make a reservation and lock it in right away.